Hello, world. This is John Pinto, your roving realtor, bon vivant, video blogger, podcaster, home chef, raconteur. And today we're going to talk a little bit about addressing increased vacancies in commercial real estate, COVID-19. So I'm here with John Dudek from Sage Settlements. How are you today, John?
Doing well, doing well. Having a nice Monday to start the week. How about you?
Fine and dandy. It's a lovely sunny day in California. So let's talk about the travails that commercial real estate landlords are dealing with. You've got a lot of see-through buildings. Um, a lot of the tenants had employees that during COVID-19 took advantage of the real estate market and the low interest rates, moved to the mountains and the suburbs and the hinterlands and started telecommuting. They kind of like that. They haven't really returned to the office yet. Interest rates, of course, have gone up for a lot of these landlords since interest rates skyrocketed after COVID-19. Tenants are not renewing or they're reducing their footprint. So all of a sudden, you have commercial landlords with much higher vacancies, much higher mortgage service payments, and perhaps they want to get out, even though their cash flow is diminished. They still have equities in these properties, and but they don't want the headaches of dealing with all the high vacancies. Tell us a little bit about how a commercial real estate investor might use structured installment sales to extricate themselves from these travails.
Well, sure. Yeah. The structured installment sale is a great tool to use if you're a commercial investor and the forecasting of what you thought you were getting into is not exactly what has become reality. As we know, COVID kind of threw everything through a loop. And so this is a way that if you're looking to get out of a property, cash it out. You can do that by making a sale, putting the sales price into an annuity with the A+ rated life insurance company, earning pre-tax interest on the amount of that sale, and spreading out your potential capital gains over a period of time instead of paying it in just one lump sum.
Very good. So just to put this in direct contrast, they could do a 1031 tax deferred exchange into other commercial property, but could be facing the same travails, the same vacancy challenges. They could trade their equity in the commercial property into residential investment property, but we all know about eviction moratorium and rent control and the unfavorable direction that tenant landlord legislation has gone in the last few years. They could sell for cash, and depending upon their tax bracket, state, federal, and the Social Security tax could wind up paying at least 37% on their highly appreciated real estate profits, and that's not counting where it could be worse on their recaptured depreciation. So tell us how, rather than those unfavorable scenarios, they might create this installment sale. And tell us about the thresholds on how much proceeds they might take out of year one when we close the escrow and ensuing years.
Yeah, absolutely. So it's you want to look at the tax brackets and kind of find the sweet spot. So again, if you're selling a commercial building and you have $1 million subject to capital gains, if you take it all in year one, you're going to pay about 37.1% on that $1 million, about $371,000 in taxes right off the bat. If instead you spread it out, let's just make it easy, spread it out over 10 years. Now, instead of having $1 million subject to capital gains, you take payments over the course of these 10 years. Now you have $100,000 a year subject to capital gains. By doing that, you drop your federal tax rate, you drop your state tax rate, you get rid of the net investment Medicare tax that's out there that's 3.8%. and those are just kind of, using basic examples, but the sweet spots to really get rid of that 3.8% and drop your federal and state rates significantly for a someone that's married filing jointly, you want to get $250,000 or below. If you are a single tax filer, you want to be $200,000 or below, because those are the thresholds where anything above that, you start paying 3.8% just on that specific Medicare tax.
Very good. And what kind of a term might commercial landlords be looking at in amortizing their full annuity over a period of years to get their entire investment back?
It's going to depend on obviously the sales price and what the original basis was, but we kind of work backwards to find those sweet spots. But normally we're seeing between 4 and 10 years is kind of the most common that we see out there.
And we know that you have to have at least two installments. Is the maximum 40 years practical consideration, or is it a legal consideration on the term needing to be 40 years or less?
That's our carrier partner, that's the A+ rated carrier that issues the annuity that eventually makes the payments to the seller, kind of takes over the payments from the buyer, the obligation of the payments. They put a limit on 40 years. This is the longest we'll make payments for this specific transaction. So, if and for someone to spread payments out over 40 years would have to be obviously a very specific situation where they didn't need the cash flow. One thing I always like to point out when we're talking about these annuities, some people have experience with traditional annuities where there are surrender periods and there are penalties if you take money out early and this and that. These annuities we're talking about, once you've made a decision on the payment schedule, you say, I'm going to take payments over 10 years, 20 years, 30 years. That decision is set in stone. You're not able to get access to any of the funds early. So when you're doing this sort of planning, you want to bring in your trusted advisors. We want to work with them, your CPA, your attorney, your financial advisor, whoever it is, to make sure that we're setting up a plan that is going to be tenable for your specific situation.
Okay, very good. Now, for this group, this audience of commercial property real estate investors, they're going to be savvy in quote unquote reinvestment rates as they're receiving their tax advantaged cash flow. And I know you and I have spoken offline about taking the installments annually or monthly. Now, of course, if you take it annually, say the first business day of each year, rather than saying if you're going to stay under the 250 normal limit to drop into the lower tax brackets, and by my calculation, that's saving about 13.8% on the various tax brackets. Can you comment a little bit about why investors may take it annually instead of monthly?
Sure. Yeah. I mean, if this is to create really just defer taxes, lower taxes, get out of a bad situation, and you want access to funds as quickly as possible to reinvest, like you said, you can have, if you're going to spread it out over 4 years, you just get a lump sum payment on, say, the January 15th of each year, and you've got that money available right away to reinvest into anything else that you want to do. If you're looking more of, hey, I want to turn this into a stream of income, guaranteed stream of income that I can rely on, and then you can do the payments monthly. So they're coming in every month over those 4 years, 6 years, again, whatever it is. So as you might imagine, the longer you kind of spread it out, the better the rate of return. So it's not going to be a huge difference whether you take it annually or monthly, but monthly will be a little bit better in the rate of return, but it'll have the same effect in the deferring and lowering of the capital gains.
Very good, very good. So before we conclude this video on how SIS, structured installment sales, could benefit commercial landlords that are possibly grappling with see-through buildings on COVID-19 tenants who are telecommuting and not coming back to the buildings. Any final words on this group?
Well, just a question for you. You'd mentioned 1031s, if you don't mind answering.
Yeah.
What's the supply like right now if you were to, sell a commercial property and flip that into another one? Is that easy to do, or are they getting harder and harder to find?
Well, on any kind of residential property right now, I don't care what it is, they're as rare as hen's teeth. People are not selling them. But on commercial buildings, which isn't my primary marketplace, one would think with the increase in interest rates and the increase in vacancy rates, you're going to have lots of property owners ready, willing, and able to sell those properties and get into a different investment.
Gotcha. Okay. Well, yeah, I think that's good to know from my standpoint. But something we like to highlight on these things is the structured installment sale, the SIS, is an option that a lot of commercial building owners maybe don't know exists. It's something that is designed to be just another tool in your tool belt when you're trying to think of the most effective way um, to move forward as an investor. If maybe there's a property that's just not working out, it's underwater. This is a way, another option outside of the 1031 to allow an investor to move forward and look at a new investment.
Very good. Very good. Well, thank you all for watching the video. This is a series, so please hit your notifications buttons, like, watch, share, and we will see you on the next video. Bye for now.